Hello friends, companies face a lot of risk when they are running their operations. And out of those risks, one of the very big risks that a company faces, funding liquidity risk. Hello friends, this is Ganesh Nayak and I help finance professionals and students to excel in their career and become a better version of themselves through a lot of trainings and development and mentoring. And I'm back with my capsule video on finance, and today I'm going to be talking about funding liquidity risk in detail, what exactly it is, how exactly a company might face this problem, and what all things regulatory requirement are related to it. Okay, so first of all, funding liquidity risk. Funding liquidity risk is a situation in which a company is primarily not able to pay its short-term dues to its creditors. Okay, now if you talk about it in a very layman language, somebody is sitting at your door asking for payment and you do not have sufficient money to make that payment to the customer or to the creditors. Now these creditors can be your trade creditors, that means people from whom you have taken raw materials to manufacture. Okay, those creditors can be your service providers, somebody who has provided you service and you could not pay back the money. Those can be your bondholders, or those can be your customers asking for refund. Okay, so the payment is not going, you do not have the sufficient amount of cash liquidity to make that payment. That situation is called as funding liquidity risk. Now if you look at bank, okay, so banking generally works on a basic principle of maturity transformation. So they take money ideally from depositors, okay, where they're committing that they will repay the money whenever the customer needs, and they use that money to invest or create asset which is long term. For example, bank issuing loans on a long term basis. So ideally they are facing this maturity issue where they are getting money for a short term period of time and issuing for a long period of time. So they generally face this risk of funding liquidity crisis, and that is a core to their business. And that is why bank has a separate team of asset liability management to make sure that they have sufficient amount of asset to cover the sufficient amount of liability. Okay, now if you are a normal company, why would you face a funding liquidity crisis? Okay, one of the very basic reason that company face this issue is basically working capital management is not done properly. Cash flow within the organization is not done properly. There are certain expenditures which were not expected but came. Okay, so all of these smaller issues can become a big problem and can lead to a situation where you do not have sufficient money to pay back to your customers. Now in terms of liquidity requirement, generally managing the liquidity of a company is the responsibility of the treasury team. Okay, because they see the entire money flow within the organization and they decide how much money is needed, when, and how they will arrange for it. Okay, so when they look at the organization, they generally try to capture the liquidity position of the organization through certain ratios. For example, you must have heard about quick ratio, you must have heard about current ratios, right? So these ratios are generally tried to assess what is a level of current asset in front of current liabilities. So that is the underlying objective of using those assets, and this gives the treasury teams an idea about managing their liquidity position. There are other ratios also, for example interest coverage ratio, that is generally used. If you talk about Basel requirements, so Basel generally talk about liquidity coverage ratio, in which you have to identify what is the total outflow that you expect for the organization in the next 30 days, and do you have sufficient amount of high quality liquid asset to protect against those kind of liabilities. So overall level, any organization or bank or a financial institution is very focused on managing the funding liquidity of their business, because if they do not have that, they can enter into bankruptcy and that can lead to a bigger problem. Okay, I hope this video was useful to you in understanding the concept about the funding liquidity risk, and we are going to be coming up with more such videos in future. So do let us know if you want to hear about certain particular topic from us. We'll do a video on that, and also till then stay tuned and stay safe. Thank you guys.